Hello, everyone. Happy Friday, and welcome back to another episode of Challenger Network News. I'm Brandon, and today I'm delighted to have my friend join us, Matt Connolly, the CEO and founder of Sønr. How you doing, Matt?
I'm doing really well, Brandon. That was a great intro. I mean, not the bit about me, just the title slide. Brilliant.
Thanks. Yeah, my radio days are paying off a little bit.
Yeah, finally.
At some point, we're
How are you
just
keeping?
into like a music thing. We're going to talk about music. That will be definitely
good.
an episode.
I'll be back for that one.
Good week, Matt. Did you have a good week?
Yeah, amazing week. Yeah, I think we are about to have our record month, which is amazing, right? So pretty tough year, 2020, and 2021 is going nuts for us. So yeah, it's good, but it's tiring. But I mean, it's the right kind of tiring. So
good to hear that.
We're now working hard to go forwards, which is a good change, right?
Yeah, absolutely. Well, it was a pretty good week for Stripe. If you saw the news, a big funding round, a 600 million funding round, valuing the company at 95 billion. They're now the most valuable private company in Silicon Valley.
Amazing, right? Did you hear the investors are talking about they will be worth hundreds of billions?
No, I haven't heard that.
Yeah, so it was Allianz guys. So they're putting the money down, and now it's coming out in the announcements and releases. So there will be multiple times of current valuation, is their prediction. Boosh. Yeah, it's a lot of money, right?
Yeah, and two brothers from a town in Ireland, less than 100 people, if I understand it, and 7 lines of code.
Yeah, not bad. Have you guys ever used it? It's I've used it in the past for a few different businesses, and it was targeted right at developers, and it's so straightforward, albeit still out my league. But it was for my development team. It was one of it was their recommendation, the obvious choice to go to, and it's just like, so yeah, so real early adoption. Even we were using it back in, I don't know, like 8 years ago, or can't remember when it was. It was really early doors.
Yeah, absolutely. Well, I think one of the things that struck me and that we were going to talk about today is obviously kudos and an incredible, next milestone for Stripe. Although just raising money isn't the end of the game, is it? It's raising money in a capital-rich environment that we've been living in for the last, I don't know, nearly a decade. It's almost. Some people judge that as the measure or use that as the measure of success. And I think it's certainly not the measure of success. At the end of the day, how can you scale? How can you become a profitable company that can grow and sustain that growth, and sustain that profit? At the end of the day, you need to make money. So, but
yeah, totally. That's what they're talking about, customers being the ultimate product market fit, right? Which is less about raising money than actually just getting some customers to buy some stuff. Yeah,
absolutely. Well, they certainly have a product market fit. That's for sure, a customer market fit. What was also interesting is, we've seen this. Obviously, venture's been around for a long time, and it's only kind of getting bigger and bigger as technology, frankly, has been dramatically transforming the business landscape for literally decades now. That you and I have spent a lot of time in the middle of that. But the rise of the corporate venture arm, I think is quite interesting. And I certainly, remarked in this Stripe deal that, Fidelity, AXA, Allianz, that you mentioned, all played a big role. And certainly we've seen corporate venture on a large rise. 50% of VC deals in 2019 included corporate money, which is doubled, in 10 years. It's still not everyone. Only 20% of S&P 500 companies have a CVC arm, so only 1/5 of large companies. But what have you seen, Matt? What in that space? Have you seen?
A few things. I think so. It's interesting. So again, 2020 versus 2021. I think there's so we've actually seen a decline. So we track investment data from all sorts of different places, right? So CVC is just one tiny part of the I don't know, the kind of the financing world, and there's still, I mean, there's tons of money out there. From a CVC perspective, we've actually seen a decline in the number of deals from last year to this year. Possibly surprised, maybe not surprised. I think there's a level of maturing for CVCs, which is, are we any good at this, right? And if we're not, maybe we should just put it down and don't touch it. And equally, some of them are performing really well, and that's attracting more into the CVC space, right? So whilst number of deals have come down, and it's just marginally, the size of total investment has gone up. But interestingly, what we're seeing is it's much more towards the top end. So it's much more the kind of the high 100 mil plus deals that they're getting involved in. And interestingly, I think there's a bit of a kind of a myth around. I don't know if you've seen this, heard it, felt it, but you know, it's always that kind of I don't know, like CVC puts their money down just when the company's reached its highest potential, you know, top of the hype cycle, that type of thing. And actually, over the last 5 years that we've been tracking this stuff, CVCs have contributed, I think it's about between 20 and 30% of all seed deals are CVC deals. And that's pretty high, right?
That's pretty high.
Albeit that's now also on the decline as well, interestingly. And that has been trickling, getting less and less. But I think, you know, so between seed and Series A, it's like 50% of the deals are still CVCs are getting involved in those.
That
interesting, right?
Yeah, absolutely. I mean, when I first started spending quite a bit of time out in Silicon Valley, kind of 2014, CVCs were known, and we put it in the title, they were known as dumb money. That was the big joke.
Yeah,
like, here comes the corporate venture arm. Here's the, you know, and I think it was a fair or not fair to be debated, but it was seen as very unsophisticated money, you know, not basically like almost like satisfying a need to feel like we're doing something, we're tapping into innovation, therefore let's throw some cash into some of these startups. And then I think that's why it started to get that reputation. But
yeah, but is that any different to the VC space? I mean, like, you know what I mean? It's there's so dumb and smart is probably worth a little bit of explanation, right? And there's lots of, you know, people. It's an ambiguous term in itself, but I think, you know, the way that we look at dumb and smart is the smart investors using data and analytics to define target opportunities, right? And then building relationships off of that and making sure it's aligned to either their kind of thematic investments or portfolio, etc. And but I think, I mean, the amount of VCs that I come across who will be using Google to kind of research their deal flow, it's like, I mean, and you're responsible for millions, tens of millions, hundreds of millions of pounds, and you're using desk-based research tools. Anyway, I think it's mind-blowing. So I think in the VC space as well as the CVC space, I think there's a lot of dumb, but there's also a lot of smart as well.
Yeah, I think that's where I come. I think dumb is an unfair. It's just too generic of a term, because I completely agree. I think, first of all, VCs invest for very different reasons. You know, different CVCs invest for different reasons. You know, some of it's there's learning, getting smart about what's happening in a space. There's obviously return on investment, but that's not always the highest priority in CVC. I think you talked about the shift from small checks to big checks. You know, I think I've seen that trend as well. And I think what's really interesting about that is there's been a realization that, hey, doing a digital transformation of our business in a very kind of piecemeal way is going to take us like forever.
Sure.
Or we can latch on to this, you know, a digital business that's got traction, that's got customers, can be a vehicle for our digital transformation. And rather than integrate it into our big machine, what can we build around this vehicle to actually be a driver for digital change? And I think that for me is a really sensible strategy. I don't know what your view is.
I feel the same, right? I think it's really interesting, right? Because for me, it all falls within the tool set of innovation, and I mean, there aren't that many tools to innovation. Okay, I mean, it's, you know, I remember, like, we spent some time in India together, right? We were going through this. We're smashing out kind of all these different diagrams and frameworks and all the rest, but it's like, you know, there are maybe 6. You know, but most of us kind of build, partner, buy, but then actually, of course, the investment side is another one, right? And this is what we're talking about today. And they all have, you know, different time horizons and different effectiveness. And I think that, you know, the long and short is, yeah, absolutely. Let's if you are a company looking to innovate, you need to, and that should be all of those companies out there, right? It has to be considerate to, or one has to be considerate to all of the tools available, and then align them to the skill sets and attitudes and behaviors and expectations of themselves as a business, and which therefore is the right tool, or which are the right tools, and then how to invest into those. But from a CVC perspective, I think, you know, to come back to the case there, you know, what we're seeing, and I'd be interested in your views on this one as well, is those that are getting it right are tending to either bring in kind of the VCs, or so, you know, the managing partners of managing directors of the VC firm in to run the CVC arm, or stealing other, you know, top caliber talent and putting them at the head of their CVC. And lo and behold, they know how to invest, as well as all the good stuff you're talking about, kind of from a strategic perspective.
Yeah, I think we've definitely seen, you know, there's more sophistication, more intelligence, like you said, but there are others who are not. Like you said, they're not leveraging data. They're not like doing what, you know, the due diligence that we would expect of anyone responsibly managing money.
Yeah, sure.
Investments. By the way, if you're watching this live, we'd love to hear from you. Please let us know a comment, let us know a question, challenge what we're talking, challenge our thinking. We'd love to see that. Just put something down in the comments in whatever channel you're watching on, and we will respond. Yeah, I do think, I mean, one of the things that we have seen, I don't know if you've seen this too, is in the earlier stages of a CVC, sometimes, you know, they hire professional investors. So, yeah, you know, they sit alongside the company, but they might not have the experience to know, like, how to engage with the business on what's going on. What are the agenda items? And, you know, are we really tied to the strategy? Are we really engaging with the leadership? Is there a real partnership? Is more, a lot of times we saw it was kind of a side thing, and you know, the business leaders on the inside kind of looking like, why are we doing this side thing? There was a big kind of disconnect. Is that a problem, or is that not a problem? I mean, should they be disconnected because therefore they can think about, you know, the true disruptive plays, or should they be connected?
So again, I mean, that's a $1 million question, and probably more, right? It depends on the business, and depends on why they're setting up a CVC. If it's for investment purposes, potentially they can separate. If it's for strategic and investment, then they need to be connected. But I think it's also really interesting. So again, bring it closer to VC as opposed to CVC, but I'll expand that out. There's a really interesting job of a VC, right? Not only is it the origination of that deal flow. So it's who should we be putting money into is the first step. Then it's building relationships, right? So how am I going to get a startup to be, an entrepreneur to trust me, to want to be open about their challenges that they're facing, so we can help them and support them on that journey. Interestingly, from a CVC's perspective, you've got that same steps, but you've also then got the other side. You've got this kind of relationship with your own business. Right. And I think to straddle both of those is really tough. It's really interesting. And so that has to be, that's a big factor in who the person is, or who the people are within the CVC. But it's also the kind of the mindset from the board behind as well. So from the company, and being accepting that they are hedging risk, right? And that's the purpose of doing it in many ways, and that they have to be open to a whole chunk of the businesses that we're going to be investing into will fail. And I mean, you know, even at Sequoia level, there's still a whole chunk of, it's 1 in 3, 1 in 2.5 maybe, will still fail. You know, it's not a done deal just because you've got Sequoia investment that you're off. And it's the same world for CVC, right?
And I think that's one of the challenges is just the leaders really understanding that mindset, having that mindset, and understanding what this is about and how it really ties in. Sure. Yeah, I think it can be quite a tough position. And then, I don't know if you've seen this. There's sometimes the pet investment that came from the chairman or the CEO. Yeah. This, and then suddenly money invested. And there's kind of maybe leads to the first question that we asked at the beginning of the show is, if there are, if there is investment going in, some of it that maybe doesn't have, you know, the level of due diligence that you would expect for responsible investing. And I'm not just blaming this on corporate venture, like you said. This happens all over the landscape, whether it's corporate or private equity. But that certainly can drive valuations up quickly. And
yeah, it really can. Right?
We land with artificial valuations, a frothy private market, and you know, always the big question that we continue to ask ourselves: are we there right now?
I know. Yeah, it's like, don't get me started on this one, Brandon.
Yeah,
no, but I mean, right, what a crazy, but what a crazy, brilliant world we're in right now, and you've got some sky high valuations, you know, and are we at peak valuation, you know? And it's an amazing question that's going to be answered only over the next few years with a bit of hindsight. But I think what I'm really enjoying, and I hope this isn't too far away from the CVC spaces, but kind of looking at this innovation pieces, is with these crazy high valuations, lots of people, so that's investors and entrepreneurs alike, are looking to get money out, right? So it's this kind of this spate of IPOs and SPACs, and what's happening is this flood of capital back into the market, which suddenly then, you know, it's VC or CVC as a service already. Okay, it's the entrepreneur who's looking at which money they're selecting from. It's now a glut of capital. And so for me, what's really interesting is you've now got these crazy valuations. That's on one side bringing in loads more money because it's getting returned to those investors. On the other side, it's loads of entrepreneurs coming into the market thinking, oh, okay, here we go. I can get set up in fintech, you know, like the Stripe guys, or insurance, like the Lemonade guys, or whatever it be. So you've got this now, even more money, even more entrepreneurs, and you've got some companies who are innovating, and I'm talking CVC as part of that kind of innovation function, and some who aren't. And it's almost kind of like, is it now about sort of dumb innovators and smart innovators? And then this growing divide between the two, that's what really fascinates me. But that is definitely a whole other program, for sure.
Yeah, absolutely. The SPAC conversation will definitely be something we cover on one of our shows. So we are ending up at the back end of our show here, but we just got a question in. I think we should answer it.
Okay.
Isn't there some sort of self-selection in play here? In a sense, outstanding startups tend to avoid corporate venture arms. Therefore, inevitably, more investments will fail as the quality of startups investments is lower. Thoughts?
Yeah, well, so thoughts. I think I challenge it. Is probably my initial thought. I think we've got the traditional, and going back to, you know, you're talking about sort of Silicon Valley 10 years ago, or was it? Did you say 40 years ago? You started working in Silicon Valley, Brandon. Anyway, whenever it is, can't remember the time zone and the timings. But it used to be that you know, so you go to VC, so you get your leadership, you get your board, you get your advice, and you get everything that you need to validate your product and kind of opportunity, right? And then you use CVC, which is just kind of rocket fuel on top, which is growth capital, right? And then you scale your business. And I think actually what you have, and this is all about the smarts of the VCs as it is the smarts of the CVCs, right? It's about the individual companies you're looking at. If you've got CVC with smarts who want to help you grow your business, then why shouldn't you be open to taking that money? So I don't think it's about avoiding CVC at all. I think you should be cognizant and contemplative towards CVC, but making sure that you're working with the right one.
But I tend to agree. I think there is some self-selection because we've seen it. You know, we see startups get funded, and you wonder how did they get funded, and then you go to see who funded them, and you start to go, now I understand why they got funded.
Yeah. Okay. Yeah.
There wasn't, you know, maybe there wasn't the same rigor, maybe there wasn't the same commitment to quality of you know, the investment, that sort of thing. I think there is some self-selection there, and as we all know, as we've seen before in the past, sometimes the money just runs out for those types of firms. So,
sure.
Matt, we could talk about this all day. We could go on, but shall
we go to the pub, Brandon?
Yes, we could.
Oh, hang on, we're not allowed
now because we're still in lockdown here in this country. But as always, Matt, fantastic to talk to you. If you please do continue to comment in the post, we'll stick around and answer any questions. And thanks again for joining us on another episode of Challenger Network News. See you next week.